Today we are joined by Rafiq Taylor, Head of Implemented Consulting at Glacier Invest. Welcome, Rafiq.
Thank you very much.
So I think one of the questions that I'd like to ask you is about Glacier Invest and putting solutions together for clients. So how do you go about this? What is the process? And what is your involvement with the advisor to try and understand and unpack solutions for them?
Yeah, so as a solutions architect, our first port of call is really to understand the advisor, their practice, and their planning philosophy, and to also understand the demographic of their client in terms of, what products are they in, whether they are pre-retirement, in preservation, or if they have a significant a client base exposed to living annuities. And depending on how their client base looks and the objectives set out based on that planning environment that the clients undertake, that will help dictate how we build portfolios. And so as an example, if you have a cohort of clients that have an inflation objective tailored to managing capital preservation, what we then need to think about is how do we build a portfolio that encapsulates both a real return objective, because ultimately those clients are going to be needing to grow their capital in the real terms. But the second part of it is really how do we manage the risk of losing money. And so that portfolio construction methodology requires a different way of thinking about how to populate the portfolio over and above the way in which we have to populate the portfolio with underlying strategies. So what normal investors would call funds, we would overlay and say maybe it's a strategy. So the strategy of, as an example, absolute return, and then finding different strategies that have the capability to manage downside and capture as much upside when the market presents itself is super important, and then overlaying that with our views around markets. And so as an example, if we in an environment where we think there's high stress and volatility is a lot higher, what we want to be thinking about is how do we create more downside characteristics in the portfolio, and when the market is cheap and we think we're going into an environment of positive markets, how do we then tailor the portfolio to then capture as much of the upside as that is there and ever present? We are fallible, and so we do make mistakes. And so our job as portfolio constructors is to understand in different market environments, assuming for a second that we do get something wrong, what is the worst outcome for those clients? And that is a fundamental around how we would then portfolio construct for those cohort of clients. And there are many cases around how we can then build different portfolio construction methodologies based on different requirements and based on the planning philosophy of that advisor.
Thank you so much.